Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and impact. I'm Govindraj Ethiraj. We've got a packed show today. First up, we're looking at Moody's, who've raised India's outlook from stable to positive. That's a good move, but is it enough? Joining me to discuss that in our show, Soumyakanti Ghosh, Chief Economist at State Bank of India, and Debupam Chaudhary, Chief Economist at Xifen Research. Next, we talk about the Reserve Bank, which has left interest rates unchanged, hoping that banks will pass on interest rate benefits to its consumers. The big question is, will banks do that? Continuing with me to discuss that will be Debupam Chaudhary and Soumyakanti Ghosh. Finally, there is a new real estate regulation bill 2013. Is it more consumer friendly? That's the bottom line question. Joining me to discuss that will be Jahangir Ghai, consumer activist, Sunil Mantri, President of the National Real Estate Development Council, and Ghulam Zia, Executive Director of Knight Frank India. Well, first up, sovereign rating agency Moody's has raised its outlook for India from stable to positive. That takes it to BBB minus, which is of course holding. It's also suggested that there could be a rating upgrade in 12 to 18 months, but that's of course if a lot of things come together in line. Now the big question is this enough, and should we be reading something into it, or are we reading too much into it? Joining me to discuss that are Debupam Chaudhary right here with me, Chief Economist at Xifen Research, also Soumyakanti Ghosh, Chief Economist at the State Bank of India. Soumya, thank you very much for joining us. So first question, the outlook has improved. However, Moody seems to be saying that the preconditions for anything further to happen are still not in place. For instance, there's a weakness in the business environment. The standards of governance are not strong. There are infrastructure bottlenecks. There is a problem with agriculture. There is complacency on reforms, and so on and so forth.
See, I would tend to broadly agree with Moody's in terms of the outlook upgrade. I think it was expected, because if you look at the history in the last 18 months, India, being one of the most fragile of the emerging economies, has now become the darling of the emerging economies. So there has been a robust capital flows, inflation has actually collapsed, prices and current account deficit has collapsed, fiscal deficit is under control, even though this year the government is pursuing a little bit of expansionary fiscal policy for the infrastructural development. Rupee has been stable and range bound. So if you look at actually all the macro factors, and today's IIP numbers also at 5%, that is also a very pleasant surprise. So if you look at all the numbers, I think the worst may just be over now, and we are looking forward to a sustained momentum in improvement in growth rate. So from that point of view, I was expecting that the Moody's should revise the outlook. And in terms of the specific issue of rating outlook, I think that will take a little bit of time, because any international rating agencies will always like to see whether the trend is sustainable or not. So from that point of view, inflation, which has now collapsed, the next couple of months could be very crucial, because this is the time when the prices actually, the veggie prices go out of control. So if the government can control those prices, food prices, inflation stays on firm footing, and current account deficit is obviously going to be very comfortable also in the next year. So if you look into all these factors and together, I think that it is a real possibility that next year possibly a rating upgrade could be round the corner.
Quick question there then, Soumya. How do we then interpret a change in outlook at this point of time? What does this really mean?
See, changing outlook, I think we are actually preparing the ground for further rating action. So I would interpret from that point of view, because you cannot suddenly go from a rating upgrade just without upgrading the outlook. So basically what the rating agency wants to say is that the outlook has significantly improved from the ground level. There is a visible perceptions of governance and activities which are actually beneficial. For example, the recently coal auction, spectrum auction, there is a whole lot of development. So there is a lot of activity on the ground. So the next stage is how far this activity will be translated into real actions and implementation. So if that goes through, obviously in the next year or so, we could see the next step of a rating upgrade.
Right. Okay. Debupam, so some of the good news, I mean, structural advantages, benign commodity prices, liquidity conditions, all of this is also not really outcome of specific government policies in India, right? I mean, there are also global factors which have helped this. So to what extent, from your point of view, is this change in outlook a result of global factors, or is it Indian?
Well, absolutely, global factors did contribute to it, but I think this is more a play of Indian factors rather than global factors, okay. Because you must understand that right now the Indian economy is approaching a very delicate equilibrium. and the fundamental factors playing a role are domestic economic trends and strengthening of domestic economic trends. So let me just give you an example. So as Dr. Ghosh was also talking about, compared to other emerging economies, India is one of the brightest stars. In fact, India is the only brightest star if you consider the BRICS conglomerate. Now, if you consider, let me talk about an indicator known as a consumer confidence index, which is a representation of what the citizens of the country on the streets are thinking about their economy. So if you consider Brazil, which is a part of BRICS, if you consider Russia and China, all three economies have seen consumer confidence to decline very steeply in the last 6 months. Now that's not a very good sign. If consumers don't spend, the economy doesn't progress. In South Africa, in fact, the funny thing is the consumer confidence is lower than the 2008 fiscal problem levels. But India is the only country amongst emerging economies where consumer confidence has been growing for the last 3 months, despite India ranking as the lowest country in this group of countries as HDI.
But confidence would mean what? It only means that at a future point things could change, but we don't know that.
Yes, it is sentiment.
Okay.
So the consumer sentiment today is in the next 6 to 9 months, employment outlook, inflation outlook, as well as overall economic conditions are going to improve, and they would spend more provided borrowing comfort rises.
Right. Okay, Soumya, so there are the risks that the Moody statement points out, for instance, in agriculture, in terms of the condition of the banking system. Now, are these concerns that can actually get worse or rather than get better, and therefore may make the whole issue of a ratings upgrade sort of push the whole issue further out?
No, I don't exactly think so, until some very external situation emerges which is totally out of control, like the taper tantrum which happened in May 2013. See, as far as agriculture, your point of specific issue of agriculture is concerned, I think yes, the unseasonal rainfalls have actually played havoc with a lot of crop destruction in the month of March. So that could have a temporary and transient impact on the inflation trajectory, and also some burden on the inflation on the exchequer, because the government has already said that it will going to compensate to the extent of 33% of the damage. So that point is well taken. However, as per the current forecast, the monsoon is likely to be normal this year as per the current trend. So if the monsoon is normal, I think a lot of these problems of these crop damages could be taken care of, and that's going to be a positive development. And as far as other things are concerned, in terms of, say, the fiscal situation, which the Moody's has also emphasized in terms of sustainable fiscal situation, I think that one of the very good developments which the government has been doing this year, I think they have started the disinvestment program in right earnest. I think this is the first time in the history when the disinvestment program started that the government has actually gone ahead with this disinvestment from the first month itself. And if that is the case, stock markets will continue to remain buoyant, because if the Moody's have revised the outlook, the capital inflows will be strong. So if that is the case, I have a feeling that the fiscal deficit of 3.9% at the end of the year could actually be overshoot. And if that is the case, I think that will be a perfect rational or a launching pad for rating upgrade.
Right. So Soumya, from what I can take away, you're saying that the outlook change is only sort of reflecting what has already happened, and you're fairly confident about things going in the same direction, and therefore a rating upgrade, but not immediately, and which of course is a good thing for the economy. What's the 1 or 2 quick impacts if there were to be a rating upgrade down the line? How could that fundamentally change things?
Absolutely, much easier for the Indian incorporation to raise funds abroad, and today the RBI also accepted the deposit receipts, the thing that happened today. So it will become much easier for foreign inflows to come into the country.
Welcome back to Policy Watch. The Reserve Bank of India has kept policy rates unchanged at 7.5% because it would like the banks to pass on the interest rate cuts that were administered earlier to the clients, that is people like you and me. The big question, of course, is why are banks, except for a handful, not really dropping interest rates? We did see 3 banks, that State Bank of India, ICICI and HDFC drop rates. State Bank and HDFC by 0.15% or 15 basis points, and ICICI by 25 basis points. Still with me are in our studio Debupam Chaudhary and Soumya Kanti Ghosh, Chief Economist of State Bank of India. Soumya, tell us, so 15 basis points, at least from a consumer's point of view, doesn't seem like much. So the Reserve Bank is obviously now upset, if I can use that word, with the banks for not transmitting interest rate reductions.
No, I don't think like that. I think if in the Indian context the situation is a little bit different, and given the 2 rate cuts which the central bank had done, I think the decline in the rates, base rates for the banks was only a matter of time. I don't think that the March could have been the ideal situation, because if you even look at the past history, March is obviously the month when the banks want to protect their margins. So any amount of tinkering with the base rate could actually hurt their margins, and hence that may be a strict no-no on the part of the banks. Regarding your specific question that why this transmission is taking a little time to materialize, I think you need to understand that in the Indian context, if you look at the asset liability profile of the banks, 97% of the assets is financed by these low cost deposits, or these deposits which are basically fixed in nature. So on the liability side we are fixed, on the asset side we are variable. So therefore whenever a transmission takes place, it takes a little bit time to transmit through the system, and in a situation when the central bank is actually on an expansionary monetary policy, historical trend suggests that there needs to be a little bit more amount of rate cuts so that the transmission impact could be felt throughout the banks. But I am sure that this could be the beginning, and perhaps in a matter of couple of months, it could be possible that more rate cuts would be forthcoming.
Right. Okay. So a few more months, says Soumya. Devupam Raghuram Rajan, Governor Reserve Bank, said credit growth is tepid, banks are sitting on money, and marginal cost of funding has fallen. The notion that it hasn't fallen is nonsense. They can borrow a margin today at 7.5% on the margin at 7.5%. Plenty of liquidity in the markets.
Yeah. So
you agree or disagree?
Plenty of liquidity, yes.
Yes.
But then the reason what I feel why banks have not been cutting rates so far until in April is, again, this is entirely my personal opinion, is because of the earnings numbers that were expected in March. So if you look at loan rates, when loan rates are cut, it is applicable across the entire loan portfolio of a bank, unlike deposit rates, which is just applicable on the new deposits. So if they cut rates, there was a direct impact on their earnings, because there was the credit offtake that was happening in the economy because of the slowdown.
Bank also said that deposit rates are too high.
Exactly. So credit offtake was not there, and on top of that, if banks had cut the lending rates, the entire loan portfolio would have taken a hit, and it would have been shown in the earnings numbers in March. So that was the reason maybe they held off from cutting the rates, and now that April is a little lighter month, they have started cutting the rates and passing on the monetary policy changes.
Okay.
Which are
So Soumya, is that the case? I mean, you know, if cutting rates would obviously affect the quality of your loan portfolio?
So see, cutting rates was an obvious conclusion. The rates would have been, the trajectory is now on the lower side. But generally the fact is that it's fixed on the deposit side, it's variable on the lending side, it makes little bit difficult for the transmission. And as I have said earlier, the banks may have avoided the month of March, so it was coming in the month of April, that I could tell you.
So, Devupam, what should be the takeaway for a borrower? You know, if I am someone who's going to buy a house, or I'm sitting on a high cost loan, what should I be looking out for?
Well, definitely borrowing costs are going to come down over the next 3 to 6 months, a cycle of 3 to 6 months, and Indian consumers are very much looking out towards that. Again, the rise in consumer confidence is very much reliant on an expectation of a more comfortable borrowing environment, which would come from lower interest rates. If that doesn't happen, consumers won't be happy, they won't be spending, and that will take a direct hit on 60% of the GDP, because consumer spending is 60% of GDP. So the authorities have to ensure.
Earlier we discussed about how consumer confidence is at a high, at least compared to some of these other countries.
Exactly. Yeah. Now if the consumer confidence index starts to come down, that would be a very negative thing for the economic prospects that we are at least foreseeing right now, the reason for which Moody has improved our outlook.
So the bet is on volume growth. Yes, Devupam, quickly.
To add to that, good times are coming for depositors also, with the sovereign bond market opening up for retail investors. So sovereign bond markets, as we all know, will offer much higher interest rates compared to regular bank deposits.
Can you give us an example? I mean, or an illustration?
So, for example, a 10-year government GSEC has been having an average rate of
7.72.
7.72 is the current, but if you look at the average, it's 8.5 plus. So that's not a bad avenue for local retail investors to park their money in, because that is as safe as bank deposits.
Okay. So, and you're saying that will offset what could happen otherwise? I mean,
for depositors, if
people are able to move from one to the other.
But banks should look out.
Okay. So, sort of sum up question, Devupam, how do you see interest rates going in the next quarter, if not two?
We are confident.
If at all, anywhere.
All our models are suggesting inflation would remain under control despite the weather imbalances, and interest rates are definitely going to come down.
So, 0.25% is what people are.
0.25 to 0.5 in loan rates.
In loan rates, okay. And Soumya, last word. I mean, what's your sense, outlook for the next quarter or not? Quarter two in terms of likely reduction?
Just before that, just one point which I wanted to mention to add to Devopam. I think one of the other factors which will constrain the banks cutting the deposit is also the fact that you can now invest in the short-term treasury bills, which offers you a significant higher return than the bank deposit. So that's another point which constrains. Now, as far as the interest rate trajectory is concerned, we are actually forcing another 25 BP cut in repo rate in the month of June, because I mean June could be the most ideal month, and given that our inflation forecast shows that it is likely to remain range bound in the range of 5 to 5.1% in the next 2 months. So from that point of view, I think the rates will come down even further, and that will give a boost to the consumer confidence and also the consumer purchasing power.
Welcome back to Policy Watch. There is a new real estate regulation bill 2013 which should hopefully change the lives of both buyers and sellers of real estate. Lots of interesting propositions: mandatory registration of all projects with real estate regulatory authorities, real estate agents should also be registered, mandatory disclosure of all information, 50% of buyers' investments have to be kept in escrow. Now that could be a very, very important safeguard. The big question is, does this really help the industry? To what extent? And more importantly, is the consumer really covered by this? Joining me to discuss that are Jahangir Ghai, consumer activist, Sunil Mantri, chairman of Mantri Realty and president of the National Real Estate Development Council, and Gulam Zia, executive director at Knight Frank India. Gentlemen, thank you very much for joining us. So let me begin with you, Gulam. Just a broad sense, right? Was the industry crying for this solution? I mean, was there a need to sort of bring things under control because it was clearly unregulated, clearly too many things were going off?
Indeed it was. It was. Actually, for a long time, there was this debate going on between various stakeholders. Should it be self-regulated, or do you really require a regulator? But whatever said and done, regulation was required, whether it was self or somebody else. However, whatever is done obviously is to take care of very burning requirement because of a lack of credibility. In fact, the industry has been facing a credibility crisis for a long time.
Right.
A buyer is not very comfortable to put the money on the table for a project which could come, say, 2 or 3 years from hence, purely because the concern about whether the timely delivery will come or not, the qualities would be as per a promise, etc. and so on. So lots of these things which were keeping or which were holding those who wanted to sign the dotted lines to steer clear.
So are you saying the most burning issue was the sort of apparent lack of trust of the buyer in the seller?
Indeed, yeah. That's exactly what I meant. And because of which, as we know, last 2-3 years, in fact, the buyers have actually gone from the market. One of the reasons obviously is this. Obviously there are other reasons, but one of the reasons is the lack of trust, as we spoke about.
Okay, and you feel that this bill is a step in that direction, but you're also hinting that it's not necessarily the solution.
Indeed, it is the step in the right direction. Right. A lot needs to be done, but at least we have started.
Okay, we'll get a sort of realtor's point of view in a moment. Jahangir, what's wrong with this bill?
I'm not very comfortable because it will not address the issues which are faced by the consumers, particularly when it comes to claiming of compensation. Under the Consumer Protection Act, I'm just comparing the two laws. Under the Consumer Protection Act, justice was at your doorstep. Each district had a district forum, and there was a 3-tier procedure: the district, state and national commission, which would expeditiously decide cases without much cost. Consumer could appear in person or through an authorized representative.
Right.
Compared to that, this particular bill seeks to have an adjudicator under Section 16.
Right. Okay, so that's at a slightly later stage. So if you were to take a step back, the bill also is saying that 50% of the buyer's investment is in escrow, which is some degree of protection, one would think. It also sort of seeks to enforce the contract between the buyer and developer. It also says the developer cannot change the plans unless there are...
But it does not take into consideration the black component, which is normally charged by the builders in advance.
Okay. Okay, so how would this have addressed it either ways?
Unless it is routed maybe through the regulator, the entire amount through the regulator, then the builder would have no chance to...
Gulam, is that feasible, routing?
Well, it's not feasible obviously because the regulator will not touch the black amount, whatever we are talking about.
So therefore we would remain only with the white component.
Okay, fair enough. So Sunil Mantri, let me get you in here. From a developer's point of view, this seems to put some restrictions but also seems to make the whole industry a safer place. What's your sense?
See, I think this regulator last few year work is going on, and government made up their mind that they want to come with a regulator. Now, whether one likes it or not, we have to accept it and we have to welcome it. That's the first point. Now, coming back to second issue, there are a lot of lacunas in this regulator. For example, this 50% escrow. Now, in some project, construction cost may be 10%. In some project, it could be 70% also. So we have suggested that actual construction cost should be under escrow and the rest of the money can flow back to the developer. Against that, 50 or 70% is suggested. That's the first point. Second point, if you just go at a little micro level detail, you have multiple level litigation forum available. The one consumer can go to consumer court, civil court, criminal court and so on, and again to the regulator, which need to be avoided because it should be one single forum or jurisdiction. If the government is coming with a regulator, regulator should be the one single jurisdiction to address all the disputes between consumer and the developer. Third most important point, which is missed by the government, that government agencies are not a part of the regulator. For example, if I complete the building within a stipulated time, now if I don't get water, electricity or the road or the drainage sewage and so on, how do I hand over the possession of that building to the consumer? So I think government agencies who are contributing a major component in the real estate sector are missed out. Sometimes there are cases, the building is completed and OC is taken, occupation certificate, for 6 or 12 months. Now, who is responsible?
Right.
And
Sunil, can I ask you to answer the sort of the fundamental question, right? So, does this make you help? I mean, I think the problems that you pointed out seem to be fair, but does this sort of take us towards a safer, cleaner environment when it comes to buying and selling of property?
Yes, I think like I mentioned in the beginning, it was the endeavor of the government, the previous government and the present government, that they want to come with a regulatory mechanism. Now, regulatory in what way, whether it would is a organization related regulation or whether it's a jurisdiction related regulation is a debatable issue, but then government has made up the mind that they want to bring some regulation in this sector, and I think from that point of the view we must accept it, we must respect it, and whatever the drawbacks and lacunas are there in this present bill, we need to suggest to the government so that they can balance all the stakeholders. That's one is a consumer, one is a developer and one is a government agencies, because government also get huge revenues, the local body, state government, through the real estate mechanism.
50% of the funds have to be kept in escrow. Now that sounds like a good thing, but on the other hand, what if there are delays?
See, first of all, the way I read it, it's a recommendation that up to 50% is to be set aside towards cost of construction. And the intent is very, very genuine and noble. The concern that we have seen in history that developers at times go belly up and are unable to complete this building construction, and the consumers suffer. So the whole point is that there should be enough money in case if the developer does not have wherewithal to complete it, they should be able to get some other agency to complete the construction so that at least those who have bought it at least have a roof on their head. So that intent is very good. As Sunil also highlighted, the cost of construction is very, very dynamic. In Mumbai itself, in one corner, you could have the cost of construction vis-a-vis the overall top line of the project to the extent of 10%. Like for example, in South Mumbai, 50,000 rupees a square feet would be cost of the value that a consumer pays, and 5,000 could be cost of construction. On the other side, the moment you go towards Virar, it could be 5,500 rupees finished good product, of which your construction cost will be about 2,000. So it varies from say 10,000 to 70,000 thereabouts. And this is something which is, as we all know, this act is something which is union government giving it as an advisory to the state governments. Right. State governments will make their own.
Exactly.
And
I think that really,
that 50, 20, 30
right.
or whatever.
And that brings me to my next question. So there is a lot of leeway within the states, which can be good and bad. I'm going to come to Sunil as well. Jahangir, how do you think states could, I mean, builder lobbies have different sort of levels of influence in different states. How could this play out?
The ultimate bottom line, as far as the consumer is concerned, is getting timely delivery and compensation or a solution to get a redressal of his grievances.
Okay.
And this bill actually tries to make out that the consumer will get something, an easy redress. Actually, it's in favor of the builder and totally anti-consumer.
Okay.
If you like, I could elaborate on that.
Yeah.
The bill provides that there would be an adjudication process. The adjudicator would be of the rank of joint secretary. Would an adjudicator be able to take care of so many complaints?
Okay.
That is question number one. Secondly, the order passed by the adjudicator cannot be enforced. There is no provision for enforcement of that order. But if one of the parties were to challenge it before the appellate tribunal, then there is a power to enforce the order.
Okay.
And finally,
Yeah.
there is a third round of appeal which goes to the High Court, and all of us know what is the cost of litigation in High Court, what are the delays.
Yeah.
So ultimately, it will not be cost effective and counterproductive.
Right. Okay. We're running out of time. Let's sum up. Ghulam, I mean, what's the unfinished agenda? I mean, having gone through the bill, appreciated the intent behind it.
See, the biggest thing, as I said, and all of us are talking about, is that government agencies should also be brought under the purview of this
Okay,
whole
that's
act,
one,
because
yeah.
without that, it's not complete. And two is that this is a huge step that we are taking, and I haven't seen any prototyping done. You know, we are talking about so many of these issues which we are expecting to crop up, the teething problems, etc. So unless you have the whole background, as you was talking about the whole regulator, how many such people do you have, what infrastructure is required? Obviously, it is not that in order to reduce the burden on the courts, you create this another something else, which will have even more burden on this authority compared to what the courts had. So, you know, so all those things are to be taken care of. Like, for example, just to cite an example, in Maharashtra, about a year and a half back, they have brought in their independent real estate regulation bill in the state.
Right.
What is the state of affairs? I haven't seen anything. It obviously requires a huge infrastructure, people who are going to be the regulator, they're people who will look into all these
do
demands.
these two things to conflict, or will the recommendatory nature of this federal bill be sort of subsumed into this state bill?
No, the point is that we have to first understand the nuances, the God lies in the detailing. I haven't seen any explanation on how are you going to sort out so many of these problems which will come up after you have rolled it out. And that is something which I don't see it yet.
Right. Okay. So that's something that we shall wait for. Jangid, unfinished, I mean, what are the issues that still need to be resolved, apart from what you pointed out on adjudication and redressal?
If it is being done, it should be tackled properly. There should be adequate number of adjudicators, mechanism to enforce the orders. Here at the appellate tribunal level, you have just one chairman and 2 members for the entire state. Not only that, the bill allows one or more states to have just one appellate tribunal. So can you imagine what would be the workload and the backlog of cases after some time?
But these cases are already getting handled in the system, right? So why should it, I mean, result in, you know, much more workload than what there is?
No, if all these were to come
Okay.
to the adjudicator and to the tribunal, it's not going to be feasible.
Okay. So you're saying, okay, so therefore have more capacity to
More
handle
capacity,
cases?
and the consumer has a right to choose,
Right.
just as the Consumer Protection Act affords an additional remedy between civil court and the consumer forum.
Right.
Same way, there should be an additional remedy. It should be the consumer's right to choose where he wants to knock on the doors for justice.
Well, gentlemen, we've run out of time completely. Thank you very much for joining us. And that's all we have time for in this edition of Policy Watch. We'll be back next week, same time. Thanks for watching.